April saw the coordinated bond and equity sell-off continue as the ECB joined the increasingly hawkish tone out of the Fed and added to economic growth concerns in the month. The moves in long-term interest rates were particularly sharp in April, but we expect a move to 3 to 3.5% in Treasury yields is now likely as the Fed begins its balance sheet reductions in the weeks ahead. However, while a further inflationary shock emerging from Russia remains a risk, 3% Treasury yields, along with a move to above 1% in German Bund yields, should begin to have a contractionary impact on growth of already slowing economies in the second half of 2022. Until the slowing growth narrative is better priced in risky assets, we suspect our capital preservation approach in fixed income portfolios will remain valuable. Recall, our focus on outsized exposure to credit long-short and credit arbitrage strategies in the hedge fund space have sheltered bond portfolios from rising yields year to date. And looking ahead, we expect they should protect against a widening in credit spreads through year-end. The spillover of these rising yields is making its way through equity and FX markets and pose a risk of more widespread instability in the months ahead. For equity investors, earnings season provided no reprieve as a more modest earnings backdrop is now being overwhelmed by ongoing pressure on PE multiples in light of the persistent rise in both nominal and inflation-adjusted Treasury yields, which we expect to continue moving through the spring. In FX markets, rapidly rising US dollar yields have triggered near a 15% weakening in the Japanese yen since early March. The Chinese yuan weakened 5% in April alone and could weaken another 5% more. Rising FX volatility, recall, was a predecessor to instability in 1994 as well as 1997 and 1998. This building stress is one of the reasons we further reduced our risk exposure in March. For more details about how we're navigating this period of rising stress in markets, please visit us on ubp.com.